By the time of the late 2010s, rates had been very low for very long. The debt level of the international banking system was utterly gargantuan, and sovereign debts across the West at a level that everybody knew was unsustainable. It was clear that there were deep problems in the financial system, and that the easy fixes of 2008 might be reaching their limits. At the same time, cryptocurrencies were beginning to creep up as a competitor in the payment sphere. Though not widely adopted, the market cap of major cryptocurrencies was truly enormous. In 2017, the market cap of Bitcoin had crossed $100 billion. Banks began looking into digital currencies, not facing a threat yet, but beginning to become concerned that this may be something that they would have to deal with. Enormous banks like UBS, Credit Suisse, Barclays, HSBC, JP Morgan, Goldman Sachs, Morgan Stanley, and Citi all began conducting research on blockchain and cryptocurrencies, wondering if they could integrate the technology in their business and stay ahead of a potential threat. Yet a major shift would come as central banks would begin looking into the technology for a much more all-encompassing purpose. In 2017, Bank of England Governor Mark Carney would give a speech titled "The Future of Money," in which he would propose the idea of a central bank digital currency. That same year, the People's Bank of China would begin investigating the digital renminbi, and in 2018, the Bank for International Settlements would publish a paper titled simply "Central Bank Digital Currencies." The idea was beginning to proliferate. Why not move the currency of a nation onto a ledger maintained by the central bank? They argued that this would facilitate payments, keep people safe from dangerous new forms of private money, make transactions easier, and even that it would increase privacy. Yet, aware of the political backlash that this would cause, they all spoke quite subtly around the unspoken motivation. This would give the central banks enormous control. The sheer power in a central bank digital currency would be staggering. The ability for one centralized institution to have total oversight and total control over the entire monetary supply of a nation and its transactions is something too incredible to resist. And the European nations, reeling from a debt crisis and the major damage of 2008, knew that if another severe crisis were to hit, then they would be a lot better off if they could control the money. It was becoming evident to everybody that there was nowhere else that monetary policy could go. There were no more band-aids for the wound. The markets were beginning to feel strained. They wanted lower rates, yet rates were in the low single digits. By the end of 2018, the Fed funds rate was at 1.5% across much of the West. Real yields were negative. If the markets were crying out for lower rates now, when real rates were near zero or negative, how were they possibly going to survive? And with so much debt racked up, how were the governments? The system had come not only to rely on low rates, but on ever-decreasing rates. This was perfectly obvious to the governments and central bankers of Europe. The only question is how long they could keep this going, and when it breaks, how would they survive? A central bank digital currency provided a perfect solution. In August of 2019, the Federal Reserve Bank of Kansas would hold the Jackson Hole Economic Symposium. Attendees from around the world came eagerly. Trade tensions between the United States and China was causing concern. Attendees feared an economic slowdown in the wake of an escalating trade war. At the time, inflation in the United States had been persistently below 2%, a target which exists because the New Zealand finance minister made an offhand comment on TV in 1988. They were concerned what such low inflation might mean. In this financial system, inflation is very important. Many were looking to Jerome Powell, who would give a keynote speech, to see if he would offer any indication on whether a rate cut was likely. Attendees would include Jerome Powell and the various Federal Reserve presidents. Leaders from central banks around the world, like the Bank of England, Bank of Japan, and European Central Bank, though Mario Draghi himself would not attend. The top officials of many nations, as well as economists and substantial market participants. The theme was Challenges for Monetary Policy. This would be the title of Jerome Powell's keynote speech. He would say that trade uncertainty was acting as a driver of slowing capital expenditure. and he would emphasize his view of a flexible monetary policy, that he was not committed to lowering rates, and that instead he would respond to the data as it emerged. There would be market disappointment at this. Many were hoping that Powell would announce a rate cut, or at least imply one. Volatility in markets would increase, and there would be increasing calls for Fed easing. Yet one paper, perhaps more than any, would stand out. Blackrock's Going Direct Plan, the paper titled Dealing with the Next Downturn. It held that monetary policy had been exhausted by the low interest rate environment. It would point out that 1/3 of developed market, government, and investment grade bonds now had negative real yields, and stated that further support cannot rely on interest rates falling. It called for the use of fiscal policy, but believed that this would be insufficient on its own. It instead called for monetary and fiscal policy to be coordinated to ensure that they were working on the same goal, something which was a quite radical departure from the belief that government fiscal policy and bank monetary policy should be independent. It proposed the notion of going direct. The Blackrock authors would go on to say that a successful going direct plan must deliver, defining the unusual circumstances that would call for such unusual coordination. In those circumstances, an explicit inflation objective that fiscal and monetary authorities are jointly held accountable for achieving. A mechanism that enables nimble deployment of productive fiscal policy, and a clear exit strategy. They would also note that in order to make this effective, that there would need to be a standing emergency fiscal facility. That would mean that there would need to be a permanent apparatus standing at the ready to inject liquidity directly into the population, directly flushing the economies with cash. In such a persistent low inflation environment, this ruling system that relied on inflation was becoming nervous. They couldn't simply drop rates anymore. So instead, the idea was to combine the governments and the central banks with a permanent standing stimulus facility to directly inject money across the economy whenever there wasn't enough inflation. This was akin to the quantitative easing band-aid that had been playing out for the past decade, but cranked up to a ludicrous extreme. Erode central bank independence, combine them into the state apparatus, all to keep this thing afloat by pure printing, straight into the economy. They were calling for the centralization of monetary and fiscal policy together, and that it should serve the liquidity needs of their failing system. The term they use is helicopter money, directly delivering money to individuals. They go on to note that a very effective way of accomplishing this would be through central bank digital currencies. Don't worry though. They go on to reassure the reader that this won't be used for the government to overspend, something which the governments of the West would never do. No, they say that this is only for emergencies. And in 2019, who could imagine an emergency on the horizon, especially one requiring a large liquidity injection? Hearing about central bank digital currencies, the predicament of Europe and the Eurodollar banks, and now calls to integrate and centralize central banks with the fiscal policy of the government, some of the American attendees became very unhappy. Central bank digital currencies would obliterate banks. If you are a banker who makes money on banking, why would you possibly want a central bank digital currency, something that you can't make money on? Well, the only reason why a banker might want this is if their wealth, their survival, is based on the survival of the system, and not on business profitability. And for the ruling factions of this imperial financial system and the governments of Europe, who are completely bound in this system, surviving another crisis was far more important than the survivability of a business. It would make sense for them to be on board with this plan, and to support capital controls. They simply needed a way to save themselves when the debt crisis got too large, survive and maintain their wealth and power. But to the American bankers, the ones who enjoyed running their banks, this was about the worst thing that one could have proposed to them. Back in 2012, the true level of manipulation in Libor came to light. It was revealed the extent to which banks were manipulating Libor rates during the time of the financial crisis. It was becoming clear to everyone that Libor was an unacceptable system, and that American interest rates couldn't be tied to a committee of London bankers. By 2014, the Federal Reserve would begin researching alternative reference rates, and by 2018, the Federal Reserve Bank of New York would begin publishing SOFR, the Secured Overnight Financing Rate, an overnight lending rate which was based on observable transactions in loans collateralized by U.S. Treasuries. Instead of London bankers on a phone, this was how much banks were actually paying for Treasury-secured overnight loans. Federal Reserve Bank of New York President John Williams would be a major driving force, and by 2019, he would be calling for financial institutions to adopt SOFR. SOFR dealt a major blow to the Eurodollar London banks. Libor had always provided them a mechanism to ensure that when American rates got outside the range of what they could handle, whenever they were too squeezed for liquidity, they could force it back into place. And now the American financial system was asserting its own interests based on its own markets above the financial faction that had ruled the world for centuries. The American bankers and much of the Federal Reserve were turning away from the Eurodollar banks and placing the interests of American finance first. There was a clear divide brewing, and a conflict was rising. Beginning in 2017, the Federal Reserve had begun backing off their prolonged period of easing. Under the leadership of Chairman Jerome Powell, this Fed appeared to be far more responsible. They had begun unwinding their balance sheet, reducing bank reserves from a peak of $2.8 trillion in 2014 to around $1.4 trillion by mid-2019. This, combined with a period of heavy treasury issuance, began to strain bank liquidity. Between 2018 and 2019, repo rates began rising above the Fed's interest on excess reserves. Repos are very short-term loans, generally only for a period of 1 day, and they're made between banks, making the repo rate about as close to the lowest base rate that any debt agreement could reach. During this period, the largest U.S. banks began shifting from net borrowers to net lenders in the repo markets. And through 2019, major American banks began reducing their cash reserves held at the Fed, prioritizing internal needs over the repo market. JP Morgan would reduce its cash held at the Fed by 57%. In early August of 2019, the American debt ceiling would be suspended, leading to a rapid issuance of treasuries. Between August 14th and September 17th of that year, the Treasury would drain over $120 billion in bank reserves. Major American banks were facing increased demands for cash in order to finance the purchases of treasuries, yet regulatory constraints and internal risk policies would limit the amount that they could make available. On September 16, 2019, quarterly corporate tax payments in the United States would result in around $100 billion being withdrawn from banks, leading to a reduction in reserves. And at the precise same time, $54 billion in long-term treasury debt would settle, increasing the financing needs of primary dealers. Repo rates would spike, with intraday rates rising over 300 basis points above the Fed funds target, a target of 2 to 2.25%. Tri-party repo rates would hit 6%. Major American banks would have the cash available to lend into the repo markets, yet constrained by regulation and internal policies, would not make the cash available. The following day, on September 17th, the Federal Reserve Bank of New York would announce that they were making $75 billion in overnight repos available, accepting treasuries, agency debt, and mortgage-backed securities as collateral. The FOMC would lower the effective federal funds rate to 1.9%. It would later be announced that this would be an ongoing daily operation, continuing to provide funding into the repo markets. To most of the United States, they didn't know what was happening. Most Americans had never heard the term repo before, and to financial markets, this was the whole story. Yet there was more going on than this. American banks were beginning to realize just how much counterparty risk may really be in Europe. This was on the back of the Jackson Hole Summit, and after years of hearing about central bank digital currencies in nations with negative rates. The ECB would drop its deposit facility from negative 0.4% to negative 0.5% on September 18th, not only pushing real yields more negative, but nominal yields to negative 0.5% as the crisis was unfolding. Barclays, BNP Paribas, Credit Suisse, Deutsche Bank, HSBC, Nomura, Societe Generale, and UBS would all make use of the Fed's emergency repo facility. Even though they weren't subject to the same tax day as American companies, they had become far more sensitive to the US Treasury than even American banks within their euro-dollar debt system, owing to just how strained a position they were in. Deutsche Bank, a bank with a market cap to balance sheet of 1.9, would finish a transfer of its prime dealership to BNP Paribas in Paris, an enormous counterparty risk event, just as the crisis emerged. It's perfectly reasonable that American banks would be far more cautious to lend to European banks, as the quality of their collateral was declining. The European banks were over-levered and risky borrowers, and as strain was already emerging in the American credit markets, the highly sensitive European banks with high demands for liquidity would find themselves in a crisis, as American banks, attempting to ensure that they did not take on excessive risk, would become far more reluctant to lend to them in the repo markets if they wanted to keep getting American dollars the way they used to, and keep the euro-dollar debt system alive. They would need more collateral. Over the following week, the acute credit crisis would begin to abate, yet something had very clearly emerged. The international credit system had shown real signs of strain, and there was far more risk in European banks than was accounted for, and it was evident that in this financial environment, even a hiccup in US dollar lending markets could cause extreme strain. American bankers were refusing to go along with the European vision. They didn't want central bank digital currencies, they didn't want helicopter money, and they didn't want going direct. American bankers saw the state of European banking for what it was: decrepit. So the American bankers said no, and all it took was a little strain and being just a little less willing to play ball than they used to be. And suddenly the Eurodollar banks looked a whole lot more precarious, with overnight lending rates rising a whole 3% higher in just a day. Cracks were beginning to emerge in the credit markets once again, and this time, everybody knew that dropping rates wouldn't save them. What they needed was an enormous liquidity injection. With the system so precarious, and everyone beginning to realize the situation that they were in, they would need something like Blackrock's going direct plan. They would need to helicopter an enormous amount of liquidity directly into the system. The only problem is that this would cause excessive inflation. There would need to be some way for the economy to remain in stasis. But how could you lock down the economy and inject it full of liquidity? There would need to be some sort of great crisis.